Hi everybody, it's Mike Martin from Huffington Post. I'm here with Stacy-Marie Ishmael from Financial Times and Alphaville,
yes,
their blog. I had the great pleasure of watching and listening to Stacy-Marie on two panels. One was with Myron Scholes yesterday regarding our risk models. And Stacy-Marie, you said in your reporting you come across managers where each level of management thinks they're smarter than the next.
yeah.
How do you think that parlays into their risk management models?
Well, I mean, what's been really interesting about the whole financial crisis is that you've had investment bankers going from being the masters of the universe to kind of being, the downtrodden group. Like the Goldman Sachs hearings this week were a case in point where they've come in for a lot of criticism
Right.
of what they've been doing. And I think what you need to understand is that to become successful in these organizations, you really have to have a mindset that you're bigger, better, smarter, faster than the guy next to you. And every single guy in the room has that mindset because that's the environment, and that's what you need to succeed. And in terms of translating that into risk management and just how much risk should we take on, if you are convinced that you really do know better than your counterparty or the market, you may be inclined to take more risk than somebody who had a more cautious worldview would put on.
One of the things that was notably absent, and we had experts, Colin Kammerer, who's at Caltech, who's an expert in behavioral finance, was the role that self-awareness and emotional intelligence play in risk management with or without models. What's your experience in speaking with traders or desk managers in terms of people who can religiously stick to their models and not kind of hijack what they know they should be doing because they get psyched out or fear or greed take over?
Well, I mean, one of the things that there are hundreds of studies showing that people, in as much as they believe in models or in as much as they believe in forecasts, have a tendency to want to go with their guts and to trust their instincts. And, it's kind of, my fellow panelist who was speaking yesterday would probably say it's hardwired into some parts of your brain. And it's very, very hard to overcome that. And in good firms, the way that it would be structured is that you would have various levels of people who would be able to say, okay, I know you think that you need to step away from the model, but actually I think that you should stick with the model. And I'm not sure that, management and oversight were necessarily structured to make that possible.
Last question. Myron Scholes, Nobel Prize. Everyone knows his model. The panel yesterday it seemed they hold him in high esteem and high regard. Some people called him a mentor. Some people referred to his mathematics as being elegant. Do you think it was a weird twist of fate or spiritually cruel for his firm, Long-Term Capital, to be taken out back and shot?
Well, I'm a great believer that financial markets are more than models. And, your models are only as good as the data and the inputs that you put into them.
Right.
And obviously, with hindsight, everything is really obvious.
Sure,
but at the time, they simply didn't realize what other correlations in the market were really affecting their positions. So, a model can only go so far. At the end there, you have to think about what the inputs are, what the overall macro framework is, and in general, what are the other risks out there, to use a well-used phrase, what the unknown unknowns might be.
Right. Thank you very much. You're very gracious of your time.